on the other end, and I assume we're going to talk about this, there are other shifts around infrastructure that are not so
right. Yeah. Let's actually move to that because and you mentioned this in your piece about, and you call it the new corporate amnesty plan. And you make a good point, right? I mean, we have basically, and just to remind people about what, as we enter into this conversation, this President Obama made this proposal, I guess it was yesterday or Monday. It's embedded, I think, in his budget. Dealing with money that U.S. corporations have made overseas and have basically stashed overseas, waiting for another tax holiday. I want to remind people as we go into this conversation that the reason why this dynamic exists is because Eisenhower, during his administration, wanted to help U.S. corporations expand their businesses internationally. And so they gave them a tax break. And that tax break was, you don't have to pay taxes on money you make overseas until you actually repatriate it, as opposed to every, whatever it is, March 15th, I think is your fiscal year, you have to file your corporate taxes. So, all right. So with that said, where are we now with the president, and where have we been in the past?
Right. Well, what that Eisenhower provision did, particularly recently, is get the accountants going at all these multinational corporations to ask, how can we make it look like a lot of our earnings are earned overseas, even if they are actually earned in the United States? And so you have things like inversions, where they cite the headquarters in a different place, or they say that, oh, our patents are in Ireland and we license our patents, and so the U.S. companies license the patents from Ireland, so Ireland is gaining all of these revenues, our subsidiary in Ireland, which is a low-tax country. That's an example of how this is done. And so, basically we've built it up to the point where now we have $2 trillion.
And David, let me just make this clear to folks. What's going on there is that the benefit for a corporation is that they are holding off on paying U.S. taxes and waiting for something, right? I mean, that's basically it.
They're waiting for something, and they know what they're waiting for, because in 2004, the Bush administration gave corporations a tax holiday. I would call it a tax amnesty, where they allowed corporations to voluntarily repatriate money at a 5.25% rate, rather than the 35% corporate tax rate. And corporations said, oh, if you just let us do this at a low rate, all this money will come flowing into America, and we will invest, and we will create jobs, and we will do all of this good stuff with this money that is now newly returned to the United States. Well, what actually happened?
Well, wait a second now, David. You're not being fair, because you're not telling us what the name of that act was. It was, in fact, the American Jobs Creation Act of 2004. Okay, so you can poo-poo it all you want. That's the name of it. So surely that's what must have happened.
Well, a report by the Senate Permanent Subcommittee on Investigations back in 2009 showed that the top 15 companies that took advantage of this tax holiday ended up cutting a net 20,000 jobs from the United States, and that the the wide majority of the money that was repatriated went into executive compensation or dividends for shareholders or stock buybacks. That's where the money actually went.
So maybe those executives, they got a new butler, servants. They got a new driver.
A real boost to the servant economy.
Right, there you go.
Exactly. So since 2004, corporations got the hint. Well, we can dodge these taxes. We can use accounting tricks. We can move money overseas. We can borrow money when we need to invest here in the United States. Apple has like $1 trillion overseas, and they borrow money to invest in the United States.
They borrow money. I mean, this is what's really interesting about this too, that we should keep an eye on, because they borrow money to even do their stock buybacks. And because they're anticipating that this money, that again, they're waiting for this next tax amnesty, as you call it, or tax repatriation. And what was interesting in your piece, you talk about Boxer and Rand Paul introduced a bill last week. Tell us about that, because, you know, and you can tell me whether or not, you know, you say that unlike that 2004 corporate tax amnesty or the American Jobs Creation Act, with a major asterisk insofar as it did not actually create any jobs, a lot of jobs were lost. You write that repatriated funds could not go to shareholder dividends, stock buybacks, or executive compensation for 3 years, but that doesn't mean that it can't go back into debt service.
Right, and it's fungible. I mean, you know, okay, that money doesn't go to stock buybacks, but a bunch of other money that it was retained earnings then goes to stock buybacks. So, I mean, that's sort of, you know, that's a full employment act for the accountants.
Right. But, all right. So just tell us what the Boxer Rand Paul.
So Boxer Paul is another repatriation tax amnesty. It's a slightly higher rate. It's 6.25%. The big difference between this and the 2004 bill is that the actual tax revenue that is gained from this money coming back, and the 6.25% rate is directly earmarked to the Highway Trust Fund. And the Highway Trust Fund is the bill that's authorized every few years for surface transportation. That's for roads, bridges, and a little bit for mass transit. And it's always short, or at least it has been recently, since we haven't raised the gas tax, which is the primary source of funding for the Highway Trust Fund, in over 20 years. And, of course, cars are more efficient. People are spending less money at the pump. And so there's this tremendous shortfall in the Highway Trust Fund. So this would plug that shortfall using this amnesty, this corporate tax dodge that is being allowed, taking that money and putting it in for infrastructure. The two have nothing to do with each other. I mean, there's nobody that says, well, all corporate tax money on foreign earnings has to go to infrastructure. They're linking it because Democrats want infrastructure projects to go forward, and Republicans want a nice tax break for multinational corporations. And you put the two together, and voila.
So there you have it. And so that is Boxer and Rand Paul's idea, I guess. Tell us what the president has suggested. And also, just do me a favor, your phone sometimes is it sounds like you're walking in and out of a tunnel, and I don't know if you remember what Michael Bloomberg said, but that's not appropriate.
Okay, I'm sorry. So the president's budget included a broad corporate tax reform, but the first step of it looks substantially like Boxer Paul. It would be a one-time transition fee that would actually, instead of being voluntary like Boxer Paul, it would be mandatory. In other words, all the $2 trillion that's parked overseas would get taxed. You wouldn't have to wait for the corporation to bring it or repatriate it back into the United States. And it would be taxed at a 14% rate, which is, of course, over twice as much as Boxer Paul, but 60% less than the actual corporate tax rate of 35%.
And I want to make something else clear about that. My understanding is that the way this works is you pay the tax rate in the country that you made it, and then so anything left over, and that basically functions as a credit against the tax rate. So if you're paying already a 14% tax rate in Germany, let's say, I don't know, I'm just I think Ireland is 11% or 12%. You're really only responsible as that corporation for the extra 2% at that point.
That's correct, and that's something that isn't really well told, is that we give credits to U.S. corporations on foreign tax paid.
So you're not really paying two separate taxes. You're paying one tax.
You're paying the float between one and the other.
Right,
yes.
exactly.
And right now you're paying the float. You're getting money. right? Because you're not paying anything until you repatriate the funds, and so you can just leave them there indefinitely. And by the way, when this money is stashed away, it's not under a mattress. You can invest that money overseas. In fact, Apple and several other corporations have this money invested in U.S. Treasuries, and they earn interest from the government for dodging taxes. The U.S. government is paying money to Apple to borrow money from them that they have stashed overseas to avoid U.S. taxes.
That's right. Unbelievable.
So, yeah. So just to get back to the president's budget, now the second part of the president's budget plan is that you would permanently put a 19% rate on foreign profits, and it would be a global minimum tax, basically. You wouldn't have to repatriate it to have to pay. You would just have to pay at the 15th of the month or whatever you said. And it would include some restrictions on these accounting tricks and tax avoidance and things like that. And that money coming in would be used to lower the overall corporate tax rate to 28%, 25% for manufacturing companies. So that's the overall plan. But remember, we have two separate parts here. The one is the near-term thing of the Highway Trust Fund. And by the way, the Obama plan, the one-time transition, that money does get funneled into infrastructure projects, just like Boxer Paul. So you have this Highway Trust Fund. The authorization of that expires on May 31st. So we have a few months to figure out how they're going to reauthorize the Highway Trust Fund and what money they're going to use to fund that. And then you have this long-term conversation about corporate tax reform, which could take years and years and years and years.
Right. So
can't you see Congress saying, all right, we'll do this one-time transition, and then we'll put off that corporate tax conversation to another time. And essentially what Obama says is a one-time transition functions as a holiday.
So in other words, what you're saying is that on some level, this entire proposal by the president is essentially a Trojan horse, or could end up functioning as a Trojan horse to basically, because now the debate is, do we give a 21% break on a tax amnesty for these corporations? Or do we give them a 28% break on 29% break?
Now you're just haggling over the price.
That's right.
I mean,
how much of a tax break are we going to give them to repatriate? Right. And what it creates is the exact same incentive for them to continue to do, them, I mean the corporations, because they know during a Republican administration, they can repatriate with 5%, with a 5% tax obligation. During a Democratic one, it may be as high as like 14%, but it's probably going to land somewhere in between, maybe a 10%. Right. That's basically what's going on.
Exactly. It signals to corporations that they can continue their strategy of dodging payment of taxes on foreign earnings and money that is earned in the U.S., but they, through accounting, push into a foreign country, and that they'll be rewarded through their power and influence. At some point, they'll be able to bring that money back at a low rate. You effectively are permanently lowering the corporate tax rate, and by a lot, by the way, because it's just a clear signal to companies that it's business as usual, and you can always sort of get bailed out by Congress somewhere down the road.
And since you can borrow against that money, it's basically, the notion of whether or not you can repatriate is really just more of an inconvenience than anything else.
It means that you can't use it for the terms of executive compensation or buybacks or dividends or things like that. But you can still use it for a lot of different functions, including making money from the U.S. government. So, right. And also you can use it for investment in foreign countries in a way that you can't in the U.S. So when and the Joint Committee on Taxation has looked at this and said, if you do another repatriation tax holiday like Boxer Paul, the U.S. government will end up losing about $100 billion over a 10-year period, because more and more money will drain away into these overseas tax havens, and the U.S. won't get the benefit of corporate tax revenue. So you can't pay for infrastructure this way. You're losing money on the deal.
And now
that's the key point.
And with the president's proposal, we basically have seen the parameters of where this is going to land, and that's the,
I
and
feel
that's
like
the problem.
it's narrowed the debate, even though the president and the White House team has said they oppose a tax holiday. Effectively, what they're giving us is the same thing, and there's two steps, and you can see Congress taking away step two and adding step one and saying, hey, this was in your budget,
Yep.
and daring the White House to stop it.